Today's highlights are all right here. Bitcoin dumped right after hitting a new high. Big players are battling for market trust. The Trump family's token launch draws regulatory eyes. Can power profit from crypto? It's a hot debate. Don't just follow Musk on Dogecoin. 3 psychological traps are the real reason for your losses. Friday, April 10th. It's time to meet again. This is BitcoinTV's Chinese channel, Where is the Chain? I'm Lucia. First, let's look at the most important data headlines from the crypto world in the last 24 hours. Short-term capital has been an emotional rollercoaster lately, swinging from a profit of 2,500 Bitcoin to a loss of 2,700 in just 48 hours. It changes in a heartbeat. A few days ago, when it was hovering between 66 and 67,000, people were actually quite calm. Buying at a small loss was no big deal. But as soon as it hit 71.5 thousand, those in profit rushed to the exchanges to lock in their gains. As a result, when the price dropped back to 68,000, those who were just profiting suddenly found themselves losing, and a wave of stop losses hit the market. It just reached 72,000 and people started selling again. Simply put, they're selling whether it goes up or down. The market has been offloading constantly, but the buying side hasn't fully caught up. This structure is quite typical. It doesn't look like a bottom, but more like chips being slowly distributed at a high level. This is very similar to the wave in March 2024. Until this rhythm stops, the market will likely continue with high volatility instead of stabilizing. Bitcoin is currently stuck around $72,000. It looks still, but there are actually strong undercurrents beneath the surface. The funding rate has turned negative, around negative 0.002, indicating that shorts are increasing and are willing to pay to maintain their positions. The problem is, the spot side isn't helping either. Tether inflows are still negative, meaning no real money is actually coming in. On the other hand, leverage is increasing, now at about 0.22. Many are using contracts to amplify their positions, with many betting on a decline. What's even more interesting is that a lot of Bitcoin is still sitting outside. The stablecoin supply ratio is only 10.5, which is far from a bull market peak. There's 47% more Bitcoin in exchanges than in the previous round. Simply put, the money is watching from the outside while the shorts are gambling on the inside. If capital suddenly enters one day and pushes the price up, these shorts could very well be wiped out in one go. The real danger isn't the longs, but the overly confident shorts. This Ethereum move is actually quite interesting. The derivatives market is starting to quietly change its tune. Binance's buy-sell ratio has climbed back above 1, with a 30-day average of 1.016, staying steady for several days. To put it bluntly, buyers are starting to outnumber sellers. Previously, these indicators hovered below 1 for years. This is a rare reversal signal we haven't seen in 3 years. More importantly, Binance accounts for over 30% of global positions. When it moves, the entire market basically moves with it. But this time, it's not that kind of pump and dump sentiment. Instead, it's a slow upward correction, showing it's not just a momentary impulse, but the market gradually regaining confidence. Simply put, it's 3 things. Buying power is back, sentiment is warming up, and the pace is quite steady. Now, this situation usually occurs when the market is just about to turn for the better, but we can't call it a reversal just yet. Please like and hit the bell icon. We'll keep a 24-hour eye on industry news for you. Now, the US crypto industry has waited over a year for a regulatory bill, which was nearing a key negotiation point, but now a more sensitive issue has suddenly emerged. Up ahead, Trump's own memecoin, Politico, revealed that Democratic Senators Warren, Schiff, and Blumenthal are questioning Trump's longtime business partner, Bill Zanker, demanding clarification on a meeting at Mar-a-Lago for Trump's biggest investors. The issue is that the organizers used the possibility of meeting Trump as a selling point, while the Trump family might be receiving fees from the token transactions. So this US crypto legislation is no longer about how much the CFTC or the SEC regulates, but has turned into a much sharper question. When the president's family is issuing coins themselves, how can the US talk about regulatory credibility? This market structure bill aims to define regulatory boundaries for the approximately $2.5 trillion crypto market, pushing exchanges, stablecoins, and DeFi into mainstream finance. But the controversy is centered on the ethical level. If the Trump family profits from meme coins, does the bill need to include a conflict of interest firewall? Politico points out that the event used the possibility of meeting Trump as a selling point to attract token buyers. Democrats question if this amounts to using presidential influence to stimulate token demand, with related transaction proceeds potentially flowing to his family.
It pushes to the core of our spine. We cannot allow American national security simply to be sold to the highest bidder.
The industry's current biggest anxiety is the time window. With the midterm elections approaching, if the bill can't pass this year, changes in the next Congress's structure will make legislation harder. The industry is pushing for regulation while simultaneously facing political pressure from Trump's meme coin. The issue has shifted from technical regulation to conflicts of interest, who regulates whom, and who has already profited before the rules are set. Now, what this turmoil really exposes are two layers of contradiction in the US crypto market. The first layer is the crypto world wanting legalization and institutionalization, hoping Congress will provide clear rules as soon as possible. And the second layer is that political figures and capital have already entered the fray, even turning presidential influence into part of the token narrative. For average investors, the biggest danger isn't the rise or fall of a specific meme coin, but when regulatory benefits and power endorsements are tied together, the market might mistakenly think the state has covered the risks. But the reality is quite the opposite. The rules aren't in place yet, but the interests have already started running. All right, let's look at this big drama in the crypto world. This crypto feud might look like gossip, but it's actually about survival. The fight has escalated from old OK coin scores to a war over personal credibility. Starshoe first questioned CZ's marital status, demanding a signed divorce decree, or else he's just misleading the public in his book and the media. CZ then countered, stating he's officially divorced, but won't release private documents just to win an argument. He's even willing to bet $1 billion and let lawyers verify it. Meanwhile, Starshoe continues his relentless attack. That's when He stepped in. She shifted the focus back to the organization, stressing that Binance is about systems, not personal stories. All three approaches are about winning trust, but Leon Lee's silence is even more telling, as staying quiet is a statement in itself. In the crypto market, capital flows toward whoever is most trusted. Factually, this dispute boils down to three main points. First, CZ and Starshoe have conflicting accounts of their time at OKCoin. Second, there's no public evidence for the rumors about whistleblowing. Third, he emphasized that Binance is a team-led company, not a personal or family business. Leon Lee's continued silence means a key perspective is missing from the whole story. There are multiple versions of the same history, but none have been fully proven. The market can only judge who's more credible based on the outcomes.
I can stay at home in my country for a very long time. I thought if I didn't go, there would probably be fairly severe consequences. There could potentially be fairly severe consequences for Binance. The company may be they could indict me, they could indict Binance. The company will be very affected. There will be a lot of negative effects for BNB holders. And there are like many of them. And then there could be a lot of negative effects for the crypto industry in general. So I thought I would just deal with the issue. To be very frank, I did not expect that I would go to jail.
This is the power of narrative. The same act is seen as taking responsibility by supporters, but as a PR stunt by critics. Why is controlling the historical narrative so important? Because when users choose an exchange, they're really choosing a story. Whether I believe in CZ's genius, Starshoe's persistence, or He's systems determines where I put my money. Whoever can convince users with a more compelling story will grow the largest. So these four are essentially fighting for future users. But be careful, there's a trap here. The more convincing the story, the more dangerous it can be. Because a beautiful startup narrative can easily hide flaws in organizational governance. Retail investors who fall for stories are the first to suffer when a trust crisis hits. So you have to ask yourself, am I trusting a person's story or a platform system? For retail investors, the only value in this feud is the chance to see clearly what you actually believe in. Next time you choose an exchange, don't pick the one with the best story. Instead, choose the one with the most transparent system, the firmest commitment to compliance, and the most stable team governance. Because history can be rewritten, but the money in your wallet, well, that doesn't lie. You think Dogecoin's ups and downs depend on Musk? Wrong. What's really swinging between sudden wealth and bankruptcy are these three psychological traps. X Money has a card now. Musk's own payment tool entered beta in April. Visa settlement cards, peer-to-peer transfers, and a 6% annual yield. But what's really heartbreaking isn't all that, it's that it's starting without Dogecoin. Initially, it only supports US dollars and traditional bank cards, with crypto payments delayed indefinitely. Once the news broke, the Dogecoin community exploded. Many people are asking, doesn't Musk love Dogecoin the most? Why doesn't X Money support it? This question hits on a much deeper level. From 2013 until now, what really explains Dogecoin's long-term existence has never been just Musk. The earliest wave in 2013 was sparked by the Reddit community. The subsequent major market trends were essentially more related to the BTC cycle, the liquidity environment, and market risk appetite. In other words, Musk can cause the biggest fluctuations, but what sustains Dogecoin isn't just one person. It's the community, liquidity, the repeated sparks within cycles, and the recognition of an established coin.
Yeah, like how do we make Star Trek real? You know, that'd be pretty amazing. I'd love that. So I think like the fastest we can make sort of Starfleet real, then we should try to do that.
The period when Musk was truly most effective for Dogecoin was actually those few months at the start of 2021. He changed his profile picture, posted memes, and kept building hype. The price went from $0.02 all the way to $0.73. But on the day of SNL, his own comment that Dogecoin is a hustle caused the price to crash immediately. This also shows conversely that he can amplify sentiment, but he can't stabilize value. In the following years, whether it's political symbols or ETF expectations, Dogecoin's volatility logic is no longer just about Musk himself. So X Money not pushing Dogecoin first doesn't mean Musk doesn't love it anymore. It means when someone goes from shouting visions to building products, they prioritize the payment foundation, compliance, and settlement, rather than catering to sentiment first. So for Dogecoin, we can't say this news is simply bearish or bullish. It's more of a reminder. Celebrities can drive volatility, but whether an asset can be discussed long-term ultimately depends on whether it has its own place in the market. Okay, let's continue. What's most worth reviewing about Dogecoin isn't its rise or fall, but that it's like a mirror, reflecting the three most typical mistakes made by retail investors. First, blind faith in celebrities. Second, blind faith in the community. Third, mistaking high sentiment for consensus. So many people lose money not because they don't understand the coin, but because they don't understand themselves. Authority bias, the most common trap in the crypto world. Musk posts an emoji and people follow, changes his avatar and they rush in, drops a meme and the market imagines a new move. But the essence is simple. Celebrities create volatility, not value. Attention can drive up prices, but attention itself isn't a long-term foundation. This is the first pitfall for many retail investors, mistaking chasing volatility for asset analysis. When it rises, you think you're on the main track. When it falls, you realize you're just following the exhaust of hype. A deeper layer is the community. Many keep returning to Doge, not for price swings, but for the sense of belonging. Soaking in the lively circle every day, seeing the same memes and jargon over time, an illusion forms. I'm not just holding a coin, I'm defending a camp. Participation turns into security, and the buzz becomes proof of asset stability. But the market never cares if you belong. It only looks at three things: buying pressure, narrative, and liquidity. Why is everyone always talking about Doge? Because the community fire never fully dies out. With the right environment, it can be reignited. The most fatal third layer, everyone in the market is talking about it. That phrase itself is a signal. Everyone talking doesn't mean consensus is starting. It often means sentiment is peaking. The human brain naturally treats what it sees repeatedly as a more important opportunity. This is called the availability heuristic. Trending topics, KOLs, and groups are all sharing it. You think you found the main line, but it's often not the start, but the end of the spread. Consensus is most valuable not when everyone is shouting, but when it's formed, but not yet overhyped. By the time the whole internet uses the same language to describe it, the cheap chips are usually gone. So looking at Doge, the most important lesson isn't whether Musk is useful, but how this psychological trap pushes people in step by step. Celebrities speak and you think it's value. The community shouts together and you think it's safety. The whole net hypes it and you think it's consensus. In the end, what you buy often isn't opportunity or logic, but the last baton in a game of emotional musical chairs. So before you rush in, ask yourself three questions. Am I seeing value or just attention? Am I relying on logic or a sense of belonging? Do I believe in consensus or just the climax? If you can't answer clearly, don't move, because you're likely the liquidity others need most when they're dumping. In the US crypto market structure bill, whether crypto software developers need federal licenses has become a focal point. Law enforcement fears exemption clauses weaken the ability to track illicit funds, while the DEFI camp stresses that writing code shouldn't equal financial intermediation. The US Senate has seen a preliminary direction for compromise regarding stablecoin rewards. Banks worry high-yield stablecoins drain deposits, while the crypto industry wants to keep product space. Regulatory focus is shifting from whether they can be issued to whether they can offer yields. Politico revealed that a Tether-linked Super PAC has started running candidate ads showing that stablecoin companies' influence is expanding from lobbying to election funding. Securitize partnered with Currents Group to tokenize Nasdaq-listed stocks and deploy them on Ethereum and Solana. Showing RWA is expanding from bonds to stocks and entering DeFi scenarios. The New York Times listed Adam Back as a key candidate, but he has publicly denied it. The event itself gave no answer but reinforced a consensus. Bitcoin still runs independently without its creator. Many think the workplace is about leveling up, but it's actually more like changing maps. Grinding for experience in one place might just mean you're in the wrong scene. And some people don't seem that busy, but always get results because they're taking a more efficient path to do the same thing. While you're still competing on who works harder, others are competing on who's better at choosing positions, using tools, and leveraging resources. So the real truth of the workplace is not that being tired makes you valuable, but that being scarce makes you valuable. Choosing the right position is more important than working hard. When you're thinking about where you have an advantage instead of how much longer you can endure, you're already ahead of half the people. So in the future, it's not the lazy people who will be eliminated, but those who keep grinding in the wrong position. Smart people don't work harder, they're better at switching tracks. Okay, that's the in-depth breakdown for this episode. Our channel always focuses on core narratives and value discovery in the digital asset field. If you agree with our logic, feel free to follow our latest news and turn on real-time notifications. To uncover a higher dimensional research space, you can follow our advanced channel. From Monday to Friday, we also share personal in-depth reviews of market cycles to capture certain opportunities within trends. See you next time.